The truth about Ponzi schemes they don't want you to know. Let's talk about Ponzi schemes and get-rich-quick scams. You probably know someone who have lost money to one of these schemes. But what exactly are they? Where did they come from? And most importantly, how can you avoid falling for them? Stick around because we're going to break it all down in the next few minutes. Where did Ponzi schemes come from? Let's start with the origins of the Ponzi scheme. The term Ponzi scheme comes from a man named Charles Ponzi, an Italian immigrant who became infamous in the 1920s for running one of the most notorious financial frauds in history. Ponzi promised investors a 50% return on their investment in just 90 days by exploiting international reply coupons for postage stamps. Sounds complicated, right? Well, it was. But here's the kicker. Ponzi wasn't actually making money from these coupons. Instead, he was using money from new investors to pay off earlier investors. This created the illusion of a profitable business, but in reality, it was all a house of cards. Ponzi's scheme collapsed when people started demanding their money back, and there wasn't enough to go around. He was eventually arrested, and his name became synonymous with financial fraud. But here's the crazy part. Ponzi schemes didn't die with him. They've been around for over a century, and they're still thriving today. How Ponzi schemes work. At their core, they're pretty simple. The scammer promises high returns with little to no risk. They attract a few initial investors and pay them back using money from new investors. This creates the illusion of success, which attracts even more people. The problem is there's no real business or investment generating profits. It's just a cycle of taking money from Peter to pay Paul. Eventually, the scheme collapses when there aren't enough new investors to keep the cycle going. One of the most famous modern examples is Bernie Madoff's Ponzi scheme, which defrauded investors of billions of dollars over decades. Madoff's scheme was so elaborate that even sophisticated investors fell for it. Regulators were blindfolded even after being tipped off by whistleblowers. But in the end, it all came crashing down, and Madoff was sentenced to 150 years in prison. Why do people fall for get-rich-quick schemes? Now let's talk about why these schemes are so effective. Why do so many people fall for them? First, there's the allure of quick money. We live in a world where everyone wants instant gratification. The idea of making a fortune with little effort is incredibly tempting. Scammers prey on this desire by offering unrealistic returns. Second, there's the fear of missing out, or FOMO. When people see others supposedly making money, they don't want to be left behind. This herd mentality can cloud judgment and lead to poor decisions. Finally, there's trust. Many Ponzi schemes are run by charismatic individuals who build trust over time. They might even pay out small returns initially to gain credibility. By the time people realize something's wrong, it's often too late. Red flags, how to spot a Ponzi scheme. So how can you protect yourself from falling for a Ponzi scheme or a get-rich-quick scam? Let's dive deeper into the red flags and why they matter. 1. Guaranteed returns. If someone promises you high returns with no risk, run the other way. All investments carry some level of risk. The reason this is a red flag is that no legitimate investment can guarantee returns. Markets fluctuate, and even the safest investments can lose value. 2. Too good to be true. If it sounds too good to be true, it probably is. Scammers often promise returns that far exceed market averages. For example, if someone promises you a 20% monthly return, that's a clear sign something's off. Historically, the stock market averages about 7 to 10% annually, so anything significantly higher should raise eyebrows. Third, secret strategies. Scammers often claim to have a secret or proprietary strategy that no one else knows about. This is usually a lie. In reality, there's no magic formula for making money. If there were, everyone would be using it. Pressure to act fast. If someone is pressuring you to invest immediately, that's a major red flag. Legitimate investments don't require snap decisions. Scammers use urgency to prevent you from doing your due diligence. 5. Lack of transparency. If the person can't or won't explain how the investment works, that's a sign something's off. Legitimate investments are transparent and provide detailed information about how your money will be used. 6. Complexity. Some scams use overly complex jargon to confuse potential investors. If you don't understand how the investment works, don't invest in it. 7. Unregistered investments. Many Ponzi schemes involve unregistered investments or unlicensed sellers. Always check if the investment and the person offering it are registered with the appropriate regulatory authorities. If you are aware of these red flags, you can protect yourself from falling victim to these schemes. Why get-rich-quick schemes rarely work? Now let's talk about why these schemes rarely work. At their core, get-rich-quick schemes are based on flawed logic. First, they ignore the fundamental principle of investing. Risk and reward are correlated. The higher the potential return, the higher the risk. Any investment promising high returns with no risk is either a scam or a fantasy. Second, they rely on unsustainable models. Ponzi schemes, for example, require an ever-increasing flow of new investors to keep the scheme alive. Eventually, the pool of new investors dries up, and the scheme collapses. Finally, they prey on human psychology. Scammers know how to manipulate people's emotions, whether it's greed, fear, or FOMO. But emotions are a terrible basis for financial decisions. The truth is, building wealth takes time, effort, and discipline. There's no shortcut to financial success. Real-life examples of Ponzi schemes. Let's look at some real-life examples of Ponzi schemes to drive home the point. Bernie Madoff. As I mentioned earlier, Madoff's scheme is one of the largest in history. He defrauded investors of an estimated $65 billion over decades. Madoff was a respected figure on Wall Street, which is why so many people trusted him. He promised consistent returns of around 10% annually, which seemed reasonable at the time. However, he was simply using new investors' money to pay off old investors. When the 2008 financial crisis hit, investors started withdrawing their money, and the scheme collapsed. Alan Stanford promised high returns on certificates of deposit issued by his offshore bank. In reality, he was running a $7 billion Ponzi scheme. Stanford used the money to fund a lavish lifestyle, including a private jet and a cricket stadium. He was eventually arrested and sentenced to 110 years in prison. OneCoin. This cryptocurrency scam defrauded investors of billions by claiming to be the next Bitcoin. Spoiler alert, it wasn't. OneCoin's founder, Ruja Ignatova, promised massive returns and claimed that OneCoin would revolutionize the financial world. However, there was no real blockchain or cryptocurrency. It was all a sham. Ignatova disappeared in 2017 and is still at large. CBEX, the recent collapse of crypto bridge exchange, CBEX has emerged as one of Nigeria's most significant financial frauds, with over 600,000 investors reportedly losing approximately 1.2 trillion Nigerian naira, around $800 million US. CBEX enticed investors with promises of 100% returns in 30 days, claiming profits generated through AI-driven cryptocurrency trading. Despite being unregistered with Nigeria's Securities and Exchange Commission, SEC, CBEX operated extensively, even obtaining a certificate from the EFCC's Special Control Unit against Money Laundering in January 2025. Following its collapse in April 2025, CBEX astonishingly resumed operations, allowing new users to register and withdraw funds, while existing investors were told to await a UK-based audit, allegedly to be completed within 60 days. The platform also imposed additional fees on older investors seeking to recover their funds. Authorities have declared several individuals wanted in connection with the scam, including both Nigerian and Kenyan nationals. The SEC has clarified that CBEX was never authorized to operate as a digital assets exchange in Nigeria, and has pledged to collaborate with law enforcement agencies to take appropriate enforcement action against CBEX and its promoters. These examples show that even the most sophisticated investors can fall victim to these schemes. That's why it's so important to stay vigilant. How to build wealth the right way. All right, so if get-rich-quick schemes don't work, what does? Let's dive deeper into some proven strategies for building wealth. 1. Invest in yourself. Education and skills are your most valuable assets. The more you know, the more opportunities you'll have. Consider taking courses, attending workshops, or earning certifications that can increase your earning potential. 2. Live below your means. Spend less than you earn and save the difference. It's simple but effective. Create a budget and stick to it. Avoid lifestyle inflation, where your spending increases as your income grows. 3. Invest wisely. Put your money in diversified investments like index funds or real estate. Over time, compound interest will work in your favor. Index funds, for example, offer broad market exposure and low fees, making them a great option for long-term growth. 4. Be patient. Building wealth is a marathon, not a sprint. Stay disciplined and stick to your plan. Avoid the temptation to chase quick profits, as this often leads to poor decisions. 5. Emergency fund. Always have an emergency fund with 3 to 6 months worth of living expenses. This will protect you from financial setbacks and give you peace of mind. 6. Avoid debt. High-interest debt, like credit card debt, can erode your wealth. Pay off your debts as quickly as possible and avoid taking on new debt unless absolutely necessary. 7. Seek professional advice. If you're unsure about where to start, consider seeking advice from a financial advisor. A good advisor can help you create a personalized plan based on your goals and risk tolerance. Remember, there's no substitute for hard work and smart decisions. Building wealth takes time, but the rewards are well worth it. And that's it, folks. Ponzi schemes and get-rich-quick scams are as old as time, but now you know how to spot them and avoid falling victim. Remember, if something sounds too good to be true, it probably is. Stick to proven strategies for building wealth and you'll be just fine. If you found this video helpful, give it a thumbs up and share it with your friends. And don't forget to subscribe for more content like this. Thanks for watching, and I'll see you in the next video.